Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, of all the investing advice you'll hear for 2026, this might sound like the simplest, even the strangest, but I believe it's the most powerful. You need to significantly cut down on your social media use. I know what you're thinking. That's it. In the age of information, I should use less information. Well, I'm not joking. This isn't about ignoring information, it's about understanding the difference between good information and dangerous noise. Now, if you listen to the insights of billionaire investor Cliff Asness, he points out that humanity has yet to invent a better engine for transforming the wisdom of crowds into the craziness of mobs than the very social platforms he uses every day. Now, to understand why this is so dangerous for your money, we first have to appreciate the beauty of a wise crowd. Now, this idea is best shown with a simple example, the audience poll on KBC or Kaun Banega Crorepati. You've seen it. A contestant is stuck between four answers. They ask the studio audience. Each person in that audience votes independently based on their own knowledge and gut feeling. And what happens? The bar graph pops up, and more often than not, the tallest bar, the most popular choice, is the correct answer. Now, that is the wisdom of crowds in its pure, beautiful form. It works because of one magical ingredient, independent thought. Now, one person might guess A on a whim, another might pick option C because they misheard the question. These random wrong answers all cancel each other out. Meanwhile, the people who actually know the answer, they all converge on option B. The individual errors get filtered away and the collective intelligence of the group rises to the top. It's a powerful thing. Now, you would think the stock market is the greatest example of this on earth. It's a crowd of millions of people all making independent bets on the value of companies. In a perfect world, all this independent research and judgment should lead to stock prices that are almost perfectly fair, reflecting a company's true worth. This is the classic efficient market theory. But something has broken. Cliff Asness argues that social media has shattered this model. It has systematically dismantled the very thing that makes the crowd wise, independence. Think about how investing happens now, especially for a new generation. You don't just open a company's annual report first. You log on, you open X, the erstwhile Twitter, and you see a stock ticker trending. Or you go to a Reddit forum and you see a flood of excited posts about a company, complete with rocket ship emojis. You watch a YouTube video where a charismatic influencer talks about their can't lose strategy. The result, instead of forming your own view, you are absorbing a collective sentiment. You see everyone is bullish, you feel the fear of missing out, that gut wrenching anxiety that everyone is getting rich without you. So you click the buy button. In this scenario, the outliers, the people with different opinions, don't get to cancel each other out. Their voices are drowned out by the roar of the crowd. In fact, their contrary views are often mocked or hidden by algorithms. So the wildly bullish opinions don't get filtered, they get amplified. They create a powerful self-reinforcing wave where everyone is just echoing everyone else. This is the precise moment when the wisdom of crowds curdles or turns into the craziness of mobs. A wise crowd thinks, a crazy mob feels. A mob is driven by emotion, by greed, by fear, by the thrill of being part of a movement. Now, we've seen this play out dramatically time and again. Remember the meme stock mania or the current IPO mania in India. Companies with shaky fundamentals, even companies with losses piling up on the balance sheets, are seeing their stock prices soar to astronomical heights. This isn't based on any change in the business reality. It is based on a collective mob like enthusiasm organized online. While the same dynamic works in the opposite direction. A good solid company can see its stock price crushed for weeks because of a negative viral story or a bad earnings report that the mob decides to punish mercilessly. So, contrary to what you might expect, social media hasn't made the market more efficient, it has made it more inefficient. Prices are now untethered from value, swinging wildly based on the emotional tides of the online mob. This creates bigger bubbles and deeper crashes. Now, if you are a disciplined investor, they should not scare you. They should make you incredibly optimistic. Value investors have always believed that the market is not a perfect rational machine. It's a pendulum that swings between irrational fear and unjustified greed. What Clay Fastness clarifies is that social media is like a giant amplifier on that pendulum. It makes the swings wider, faster, and more dramatic. This increase in efficiency is not a threat to you, it is your single biggest opportunity. It means there are more moments when you can buy wonderful businesses at a discount because the online mob have irrationally hated them. It means there are more times when you can sell when prices have been pushed to silly, unsustainable highs by pure hype. The crazier the mob gets, the better it is for the calm, independent thinker. So, your practical strategy for 2026 is this: handle social media with extreme care. This does not mean you have to unplug entirely. These platforms can be useful tools for gathering data points and seeing what narratives are circulating. The danger is not in using them, it's in letting them use you. The danger is in outsourcing your judgment. Your new rules are simple. Never take a direct stock tip from a viral post. Let it be a starting point for your own research, never the end point. Question the herd's assessment. If everyone online loves a stock, be extra skeptical. If everyone hates it, look for a potential opportunity. Use social media for information and not for decisions. Your final decision to buy or sell must be grounded in your own research, your own logic, and your own understanding of a company's value. This requires courage. It requires the courage to avoid a popular stock that your own analysis shows is overvalued. Even harder, it requires the patience to invest in a great company that the online world is completely ignoring. This brings us to the timeless wisdom of Warren Buffett, who famously said that the stock market is a device for transferring money from the impatient to the patient. Let's think about that. The social media mob is the ultimate expression of impatience. It is driven by the need for instant gratification, the hype of the next big thing, and the panic of the latest headline. Your strategy, in stark contrast, must be rooted in patience. By consciously turning down the volume on the daily craziness, you free your mind to focus on what actually matters: the long term value of a business. You can wait calmly for the market to eventually recognize that value as it has throughout history. The greatest rewards in investing will never come from following the hottest trend of the day. They will come from the steady, disciplined, and often lonely application of your own independent thought. In the incredibly noisy, hyper-connected world of 2026, the most revolutionary and profitable act an investor can commit is a quiet one: to simply think for yourself. Well, that's all from me today. I'll see you again in next session. Goodbye and happy investing.